In the last video, we recorded journal entries, but there's one transaction that trips almost everyone up: loan payments. Because when you make a payment, you're not just paying one thing, and I'll explain in this video. Every loan payment has two parts: the interest, this is the cost of borrowing, and this is an expense. And the principal, this reduces what you owe, and this reduces a liability. So you see one payment, but there are two financial effects. All right, so what we want to do is we want to figure out what journal entries we need to make in order to record this transaction when the car payment actually happens. Okay, so the journal entry, that's the end goal. There's a process, though, that we have to follow to get there. So what you're going to want to do is you're going to want to find out what the beginning balance is on this car loan as of right now. Okay, don't worry about what it was when you took it out, although you will need that to record the asset, or pardon me, to record the liability, the car loan payable. But really, the car loan payable liability is equal to whatever the value is today. So we want to take that beginning balance, and this will be the balance if you have a statement before your payment has been made. Okay, so it'll be the ending balance of your last statement. So we're going to assume, for the purposes of this example, that balance is going to be $18,000. Okay, and we are also going to assume that the rate on this car loan is 6% annually. But because we're doing this on a monthly payment, we want the 6%, 6% divided by 12, okay, to get a monthly amount. Now, the payment will be based on what the original value of the loan was, and we're just going to assume that that payment is $550. And the ending balance is not the ending balance for this term. It's just the ending balance once the entire loan has been paid off, and that's 0. Now, one function that you can use is called the NPER, so NPER function. And what this is going to tell you is how many months are remaining in this loan, okay? And in order to calculate that, you need to input the rate. So we just grab that from here. We grab the payment, which is 550. Now 550 is a negative number, right? Because it's a cash outflow. So we've got to make that one a negative. We want the present value, which is going to be not A2, but B2. We want the future value, which is just going to be this ending balance of 0. And we're going to say that this payment is being made always at the end of the period. And we're assuming that this is the end of the period right now. So we just click 0 for end of period. So when we do this, we get 35.827. That essentially tells us that there will still be a little bit of a balance remaining after 35 months. So 36 months is the total number of months remaining. So we want to create our amortization schedule. And I'm going to move through this pretty quickly. There is another video that talks about it in detail, how to create this. But essentially, we want all of our months here. So 1, 2, and then you can fill this by going all the way down to 37. Okay, that'll give us 36 periods. We want our beginning balance to equal the beginning balance here, the 18,000. Our interest amount is going to equal the 18,000 multiplied by the monthly interest rate. And we want to anchor this monthly interest rate because we're going to drag and drop as usual. So we see that the interest component is 90. The payment is going to be from our inputs, the 550. Okay, and again, we want to anchor this because it's not going to change. The payment stays the same throughout the term. This means that the principal is going to be the difference between the payment and the interest. And the ending balance is going to be the difference between the beginning balance and the principal reduction. Okay. You don't need to do this because we're really only just calculating for month one, but just because it's beneficial to see this time and time again, I'm going to do this. So the beginning balance here in month two is going to become the ending balance of month one. We're going to take all of these values, drag them down here. We can see that the payment stays the same. The interest portion goes down a little bit. The principal portion goes down a little bit, etc. And then we can grab this whole row, drag it all the way down to 36. And we see here in this last month that there's an opening balance of $453. So we don't want to make a $550 payment. We want to make the payment that includes both the principal and the interest. So equals this plus the interest. And that will be paid off at 36. Now, the nice thing about completing this amortization schedule is that it gives us the information that we need to record the transaction, okay? So we need to make sure that we go through this because it gives us the values that we need for that car payment. It's not a car payment expense, don't get that wrong. It is a car payment, but it's the cash component is the full 550, but that payment consists of both principal and interest. So in our chart of accounts, we're going to have cash, okay, because that impacts so many different accounts. We're going to have a car loan payable, and we're going to have the transport interest expense, okay? These are the different items that are going to be impacted by this journal entry. So if we come to our journal, we're going to put in our description the first component, which is the interest on car payment. Okay, this is just the description. And let me just make this a little bit bigger. There. Okay, so the interest on the car payment, what's going to be impacted? Well, our transport interest expense is the first component. And the second component is cash, because a portion of our cash payment is going toward the interest expense. And how much is that? Well, we go back to this value here, which is 90, and that's the amount that we're including for that portion of this transaction. But we're not done, okay? Now we have to put in the principal on car payment. Okay, so remember, our liability for our car loan payable is a credit position because liabilities increase with credits. In order to reduce that liability, we need to debit the car loan payable. That's how we take care of the principal portion. So car loan payable. And again, this is cash because a portion of that $550 payment is going toward paying down the principal of the car loan, and the other portion is going toward the interest expense. So we go back to sheet one, we say, okay, the principal portion is 460, and we record 460 here. Okay, so that is how to deal with car loan payments. And each month or each payment that you make, you would need to refer to that amortization schedule. And oftentimes you can receive these from banks. If you ask for them, they'll give you the amortization schedule. But I've already shown you how to create one in here very quickly, but in another video. Okay. So I want to emphasize this is called a compound entry. For the one transaction, which is the car payment, there are actually two different rows that you need to update within your journal. There's 2 debits and there are 2 credits impacting cash, which really could be 1 credit, but we want to keep 1 row per debit credit combination. So let's step back and look at what just happened. From a single payment, our cash decreases, the loan balance decreases, and an expense is recorded. This one transaction affects both the balance sheet through the car loan payable and the income statement through the transport interest expense. This is why accounting matters and understanding these compound transactions matter. Yes, there was a single cash flow, but it has a different effect on our financial performance and our financial position.